Just now, and let's connect with him to understand the market texture, what he makes of the global environment, and in the short term, when I say next 3 to 6 months, Mark feels that seasonality could be at play. Mark, fantastic to have you back. Is that a Santa tie by any chance? I can see red, but is there Santa Claus on it?
It's just a regular tie.
So the Santa has not come. Do you think the Santa is going to come this year before year ends? Santa, the bull market Santa?
Santa rally, yes. I think we're starting to see it now. Technically, isn't that the period between 25th of December and the end of the year?
What makes you confident, or what gives you a underlying thought that the Santa this year will not disappoint?
Well, as I said, specifically, the Santa rally is from the 25th of December to the end of the year. So that's only 5 or 6 days. And who knows if that'll happen or not. But I do think that the market should go up. And there are several reasons. The first is that I think the economy in the US will slow next year, but not enough to be in a recession. We're looking for around 1% GDP growth next year, which is extremely low, obviously, but it's not zero. And you still have a lot of growth coming from these big technology stocks and earnings. And I think that will continue because of the investments they're making in their cloud computing businesses with generative AI, and that will be incredibly accretive for their revenues, but for the entire S&P over the next few years. So those are the two main things, I think, is that we're going to have the economy decelerate, but not enough to be in a recession, but enough that the Federal Reserve will be more relaxed about inflation and interest rates. And then number two, still very strong structural growth in technology through the generative AI story.
You talked about S&P, you're talking about technology, i.e. NASDAQ as well, but for a bit of a long term, let's say, next 3 to 5 years, if I can call it that, would you prefer Indian markets over the US markets, or continue to be overweight US versus India?
My best guess is they'll do about the same, but I do feel that the United States is the best market to invest in equities and, by the way, in bonds. And there are many, many reasons for that have nothing to do with GDP growth, of course, because in the United States, GDP growth being a mature economy is relatively low. But we should have figured out by now, looking at China, that there isn't really a correlation between GDP growth and stock market performance. And in America, I think what it comes down to is simply that the technology sector is the largest sector in their stock market, and it has returns on equity in the mid-20s, sometimes even in the 30s. It's an incredibly profitable sector. And they just have the ability to invent and create great new things. And so I think with generative AI, we're on the cusp of that all over again. I was just thinking this morning how back in the 90s, I didn't know anybody who was working in the technology sector, apart from a cousin who worked at IBM. And now I have many, many friends in the technology sector. And the reason is because those magnificent seven, they didn't even exist back in the 90s. And I think that with generative AI, we're on the cusp of a whole bunch of new technology companies. They probably don't even exist right now, but they will over the next 10, 20 years. They'll rise and become big. And that's something that you really see only in the United States.
Mark, hi there. Morning. What's the outlook when it comes to the earnings growth potential as well for India? What is it that you're forecasting versus the rest of the world?
Above average, so in the high teens, potentially low 20s. And you're right that it's good. So I was just talking about the United States, but absolutely the appeal of India is the earnings growth. And I think that's being driven by, in part the strong economy, but also the resilience of the banking sector after years and years of taking that painful medicine of writing down the non-performing assets is now in a place to lend. We've got a capex cycle. I think that's undeniable, and it'll continue. And the banks are the biggest sector in the Nifty.
Mark, now the biggest moving part in last 12-18 months has been how long interest rates will move higher and when will they hit a roof. Assuming that interest rates is not a moving variable for 2024, but elections are or will be both for India and for United States, two largest democracies would be voting. What kind of volatility do you think it will create?
Well, I have to politely disagree with the way you've asked the question, because I don't think that politics are a defining factor of the market. They never really have been. You might remember in the lead up to the 2016 election, people were terrified of Donald Trump. Well, we ended up having great stock market performance during most of his administration. It wasn't really until the very tail end when the pandemic came along, and that wasn't his fault. So I really don't think it matters that much who wins the US presidential election. And in India, I don't think there's going to be actually much chance of the opposition coming in. I prefer to focus on the earnings growth in both places, and I think in both places it'll be good. So I mentioned India will be high teens, but we're probably looking at low teens. So I'll just put out a low number of 11% earnings growth in the United States next year and the year after. It's hard to see the market go down if you've got double-digit earnings growth.
So banking is one space that you're looking at positively, but how else are you playing the India theme? Is consumption something which is on the anvil? Real estate has been doing well. Have you been dabbling into any of those names?
Yes, very much so. Real estate we would play through building materials, which also benefit from the infrastructure spend. The consumer is definitely a good story in India, which would benefit from the rising GDP per capita. Ernst & Young think that GDP per capita, which is about $2,600 today, will be $3,700 by the end of this decade. We would like to play that through the automotive sector. And then we like pharma, because it looks like the price pressure in US generics is coming to an end. So there's several other things, but to go back to what I said originally, the banks, I think, are, as simple as it sounds, a good way to play the fact that you have a capex cycle after many years when the corporate sector really was starved of capital because it couldn't get loans, and now it can. So to me, that just kind of, I hate to use the term, but it just kind of looks like a no-brainer.
There is an important point which, Mark, you've said that this is part of your core philosophy. It is fun to listen to the market. Don't let that influence your investment. Buy good quality companies when there is fair price and buy more if they fall more. So what is the market chatter which you're ignoring, and what is a good quality company which is there on your radar?
Well, first and foremost, the politics. I think you can ignore it. And I'll give you a classic example, as gruesome as it is and unfortunate as it is, what's happening in Israel, which is not impacting the market. Look at the oil price. It's back in the low 70s now. And so I just think that what you want to invest in is good quality companies. They exist everywhere in the world, by the way, but they seem to be more prevalent in the United States than anywhere else in the world. And I think the reason for that is because the middle class in the US is highly invested in the equity market, and it insists on good corporate governance and shareholder returns. And if you don't get that, they'll change the board, they'll change the management. Also, in the United States, the way the S&P 500 index is created, obviously it's a weighted index, and so it naturally pushes the best companies right to the top. The worst companies get pushed right out of it, and there's a whole bunch of companies in the middle that get acquired. So actually the average lifetime spent on the S&P of a company is only 12 years now. That's down from 60 years back in 1950. And the reason is because the M&A is so strong there. And so I could name a whole bunch of other reasons, but that's what all you need to do is buy the good quality companies and hold them. And now the thing is that companies do change over time. I mentioned IBM earlier when I said my cousin worked there. IBM was the great stock back around 1965, and today it's obviously not nearly what it was, so you do have to be nimble, but in a way the S&P 500 index does that for you because it's constantly making the changes of the companies.
Mark, would also be interested to know, I'm sure that you're a voracious reader and there have been very interesting books that you've come across, but would there be anything in particular that you would like to, advise our viewers to or recommend, maybe something you've read recently that has caught your attention or made you think a little bit more?
Well, just because I mentioned the 1960s and IBM, there's a book, I didn't read it recently, but a book I like called The Go-Go Years by a fellow named John Brooks. And he was a financial journalist, a little bit like the Michael Lewis of the 1960s. And the Go-Go Years, just to preface it, we all know the meme stocks, a couple of years ago. And those all tanked, didn't they? They went down about 80%. We all remember the dot-com collapse. And stocks also went down about 80%, the NASDAQ. So the go-go years were a very similar technology-driven bull market in the late 1960s. And the few dozen stocks, IBM was one of them actually, that everybody was enraptured with back then. They went down over 80% in the early 1970s. And so I just thought it was interesting to read that book, apart from the fact that John Brooks is a fabulous writer, so it's highly amusing to read. But you just realize that this trend of technology-driven bull markets happens over and over again in the United States. I suppose I'm contradicting what I said earlier about the great thing in the S&P is technology, but I think that it is great because the S&P is an index that pushes the best companies to the top and then pushes the worst companies right out of the index, so you don't get stuck with a bunch of deadwood.
Good chatting with you as always. Appreciate you making time and speaking with us. But